A year ago, I made a video about diagonal spreads. In today's video, I will add more to that. Hello everyone and welcome to my YouTube channel. In today's video, I will explain what diagonal spread is, the best time and price to trade a diagonal spread, and how to manage a losing diagonal spread. If you enjoyed this video, please like and subscribe to my YouTube channel below. So what is a diagonal spread? To put it in a simple term, a diagonal spread is a combination of a vertical spread and a calendar spread. A diagonal spread involves selling a short expiry options contract and buying a long expiry option contract simultaneously with different strike prices. The strike price of the short expiry option and the strike price of the long expiry option are usually out of the money and in the money respectively. For simplicity reasons, we will only focus on a bullish call diagonal spread strategy in this video. So what is a bullish call diagonal spread? A bullish call diagonal spread involves selling and buying short expiry and long expiry options contracts respectively with different strike prices. The strike price of the option contract sold is higher than the strike price of the option contract bought. If you are familiar with the covered call strategy, a bullish call diagonal spread is similar to the covered call strategy, but at a lower cost. Now that you know what a diagonal spread is, what is the best time and price to trade a diagonal spread? A diagonal spread is a directional option strategy, so there is no specific time or price to place a trade. Just like stocks, we don't know the right time or price to buy or sell a stock. However, there are market conditions that are favorable for a diagonal strategy, and these are trading diagonal spread during low implied volatility and avoiding trades during binary events such as earnings reports and economic data reports. When trading a diagonal spread, cover the cost of the extrinsic value of the long expiry option using the credit received from selling the short expiry options contract. The extrinsic value of options decay over time, so by covering the cost of the extrinsic value of the long expiry option, an options trader could profit or break even if the stock stays stagnant during the length of the short expiry options contract. And the last thing you should do is aim for a 15 to 25% return for every diagonal spread trade. If you don't know how to calculate your return, please check my previous video on a diagonal spread. How do you manage a losing diagonal spread? If you are familiar with the covered call strategy, a bullish call diagonal spread is managed similarly to a covered call strategy. For example, on June 25, 2021, a bullish call diagonal spread was traded on stock 𝐃𝐢𝐬𝐜𝐿𝐿. A $60 strike call expiring on July 16, 2021 was sold at $7.07. And a 39 strike call expiring on January 21, 2022 was bought at $23.85. The net debit was $16.78, the break-even price was $55.78, and the maximum potential profit was $4.22. On July 13, 2021, 3 days to the expiry of the $60 strike call option contract, stock 𝐃𝐢𝐬𝐜𝐸 dropped to $38.06, resulting in a massive loss. To manage this trade, we have to make a decision. Close the trade and take a loss, or adjust the trade to reduce the break-even price. I adjusted the trade by rolling the $60 strike call option to another expiration date. This was done through a calendar spread which involved buying to close the July 16, 2021 $60 strike call option and selling to open the August 20, 2021 $60 strike call option. The trade was placed for a net credit of $1.42, and the break-even was reduced to $54.36. The goal of this adjustment is to reduce the break-even price as much as possible to the current stock price. And we do this by rolling the option contract sold to the next expiration date. The options contract with the long expiry is not adjusted. And finally, an options contract is not sold below the break-even price, as this may result in a loss that cannot be avoided. To conclude, a diagonal spread involves selling and buying options contracts with different expiration dates and strike prices. There is no specific time or price to place a trade. However, trading in a low implied volatility and avoiding binary events are favorable. Lastly, the goal of managing a losing diagonal spread is to reduce risk. You can do this by closing the trade for a loss or adjusting the trade to reduce the break-even price. Alright everyone, this is the end of the video. If you enjoyed the video, please like the video and share it with a friend. If you have any question, please ask in the comment section below. I am excited to answer your questions. Thanks for watching and have a nice day.